Today, let's talk about something that might sound complicated but has massive implications for your money and the overall economy, the inverted yield curve. Now, you've probably heard it in the news whenever the word recession comes up, but let's break it down in a way that actually makes sense. First, the yield curve. Imagine it as a chart that shows the interest rates on government bonds of different lengths of time. Normally, if you lend the government money for 10 years, good investment, you'd expect to get paid more interest than if you only lend for 2 years. That's common sense, longer time, bigger risk, higher reward. That's what a healthy economy looks like, investment. But here's where things get interesting. Sometimes that chart flips upside down. Short-term bonds start paying more interest than long-term ones. This is called an inverted yield curve. And it usually means investors don't feel confident about the future. They're willing to accept lower returns for the long term because they believe interest rates will fall, growth will slow, and trouble could be ahead. History backs this up. Every major US recession in the past 50 years has been preceded by an inverted yield curve. It's not perfect, but it has a track record that's hard to ignore. Think about 2001, 2008, and even the slowdown before the pandemic. Each time, the yield curve sent a warning. So, what can you actually do? Don't panic, but prepare. This means building up your emergency fund, avoiding high interest debt, and being cautious about big financial commitments. If the economy slows, the people who survive and even thrive are the ones who plan ahead. Use this warning as an opportunity to strengthen your finances instead of fearing what might come. Because here's the truth, recessions are a natural part of the economic cycle. They come and go. But if you manage your money wisely, you don't just survive them, you come out stronger on the other side. The yield curve might sound technical, but at its core, it's a simple concept that shows us how investors view the future of the economy. Think of it as a line graph that plots the interest rates on government bonds with different time frames, from a few months all the way up to 30 years. In a healthy, growing economy, the curve slopes upward. That's because investors expect to earn more interest when they lock up their money for a longer period. After all, the longer you commit your money, the more risk you're taking on. So the return should be higher to compensate. For example, if you buy a 2-year treasury bond investment, you'd normally earn less than someone who buys a 10-year bond simply because the 10-year bond holder is tying up their money for much longer. That's the natural order of things. It's also a reflection of optimism. When people believe growth and inflation will continue, they demand higher returns over time. The yield curve becomes such an important signal because it reflects collective investor behavior. It's not just about 1 or 2 people buying bonds. It's about trillions of dollars moving into or out of certain maturities. When short-term bonds start paying more than long-term ones, it flips the curve upside down. That's unusual, and it tells us something is shifting in expectations. By understanding the basics of the yield curve, you can see why economists and investors pay so much attention to it. It's like the heartbeat of the financial system, quietly signaling where things might be heading. An inverted yield curve is one of those signals in finance that grabs everyone's attention because it flips the normal relationship between short-term and long-term bonds upside down. Under typical conditions, investors demand more interest for lending money over 10 or 20 years compared to lending for just 2 years. But when the yield curve inverts, short-term bonds actually pay higher interest than long-term ones. That might sound strange, but it happens for a reason. Investors start to expect weaker economic growth ahead. Think about it this way. If investors believe the economy is heading toward a slowdown, they expect the Federal Reserve to eventually cut interest rates to stimulate growth. So instead of parking money in short-term bonds, which are tied closely to current interest rates, they pile into long-term bonds, pushing those yields lower. This flood of demand for long-term bonds creates the inversion. In simple terms, it's a vote of no confidence in the near-term economy investment. The reason it's seen as a warning sign is that it reflects collective behavior from some of the largest, smartest money managers in the world. Pension funds, hedge funds, investment, and institutional investors don't move billions of dollars around for no reason. If they're seeking safety in long-term bonds, it's usually because they anticipate turbulence ahead. That's why an inverted yield curve is not just a technical chart pattern. It's a real-world signal of fear and uncertainty. It doesn't guarantee a recession, but it has been one of the most reliable predictors we have. History shows that an inverted yield curve has been one of the most reliable early warning signals for recessions, Investment, even if it doesn't predict the exact timing. Looking back over the past 50 years, every major U.S. recession has been preceded by an inversion of the yield curve from the early 1980s to 2008. The pattern is consistent when short-term interest rates rise above long-term rates. It signals that investors are increasingly worried about the economic future. For example, before the 2008 financial crisis, the yield curve inverted in 2006-2007. At that time, short-term interest rates were climbing due to Federal Reserve policy, while investors began buying long-term treasuries in anticipation of a slowdown. That inversion didn't cause the recession, but it reflected a shift in investor sentiment, a collective acknowledgement that growth was likely to slow. Similarly, the curve inverted in 2000 before the dot-com bubble burst, again providing a clear signal that economic conditions were about to change. It's important to understand that the yield curve doesn't act in isolation. Analysts look at it alongside other economic indicators like unemployment rates, manufacturing activity, and consumer spending. Still, its predictive power stands out because it aggregates the expectations of millions of investors. When those expectations turn cautious enough to invert the curve, it's often a sign that the economy is heading into rough waters. In essence, history shows that while the yield curve might not tell us the exact day a recession starts, it has been remarkably consistent as an early warning sign, giving investors and policymakers a chance to prepare for what's coming. When faced with the warning of an inverted yield curve, the most important thing is not to panic, but to take practical steps to protect your financial well-being. The good news is that you can't control the economy, but you can control your personal finances. Start by focusing on building a strong financial foundation. That means having an emergency fund that can cover at least 3 to 6 months of living expenses. This acts as a safety net if the job market slows down or if unexpected expenses arise during an economic downturn. Next, look at your debt. High-interest debt, like credit cards or personal loans, can become a heavy burden when economic conditions tighten. Paying down these liabilities reduces financial stress and frees up cash flow for smarter investments. Speaking of investments, it's wise to review your portfolio. Diversification becomes even more critical during uncertain times. Allocating your money across different asset classes, stocks, bonds, and perhaps alternative investments can help reduce risk while still allowing for growth. Another key strategy is being cautious about major financial commitments. Whether it's buying a new home, starting a business, or taking on large loans, slowing down and evaluating risks carefully can prevent overextending yourself. Lastly, use this time to increase your financial knowledge. Understanding market trends, interest rates, investment, and economic indicators like the yield curve allows you to make informed decisions rather than reacting emotionally. In short, investment. An inverted yield curve doesn't have to be frightening. It can be a signal to get proactive. By building a safety net, reducing debt, diversifying investments, and staying informed, you put yourself in a position not just to survive a potential downturn, but to come out stronger on the other side.